morning, everyone. Wow, I'm so impressed. 9 o'clock in the morning. Pretoria, Johannesburg, that's quite something. We are here today to talk about venture capital investing in companies which are truly trying to solve some of the world's greatest problems. Things like climate change, healthcare, food security. And of course, we've got new tools which are helping that, such as AI, and we'll talk about all of that today. Venture capital investing, from my perspective, is truly the new frontier of investing. And ESG is a little bit of a passé thing, which many companies, I saw BlackRock here, have already withdrawn from in terms of evaluation of companies. So if you're looking at wanting to make an impact in terms of investments, it's impact investing, and it's venture, and it is what we are going to talk about today. With me, I have a panel of experienced portfolio managers and research analysts who work for Bravos Investment Advisors. It's a venture capital firm based in London and US, which focuses on investing in companies which are premised on commercializing of IP emerging out of Oxford University. So let me start by introducing my panel. With me is Andre Crawford-Brandt. He's a co-founder of Bravos, as well as its chief investment officer. He is a very seasoned investment professional with over 28 years of experience in investing in private and public markets. And he's been an investor in Oxford ecosystem in particular since 2015. Jacob Goodwin, on my left, is an investment principal at Bravos. He has over 10 years worth of experience investing in VC companies, and Jacob heads up all of our research. He is also an Oxford alumnus, as is Arjun Dasanacharya, who is a senior researcher at Bravos. He was a master's student at a famous Genus laboratory at Oxford University, and his particular focus is healthcare and biotech. And finally, our resident AI expert, Alex Peel, who graduated in Masters in AI and Robotics from Columbia University. But interestingly, and that's the angle, he intends to study law at Harvard to protect humanity against AI. So I want to thank them all for flying in from UK and US to be here today. Now, let me start with Andre. Andre, we've all heard about venture investing. High risk, small companies, new companies, potentially massive returns. So what makes VC investing so successful in your eyes?
Thanks, Magda. You mentioned venture investing as a new frontier. It's actually an old frontier as well, and there's a great article in The New Yorker that I think summarizes this relationship between risk and reward. And small history lesson, but back in the 1850s, there was a town in Massachusetts called New Bedford that was the center of excellence for whaling, and at the time actually was the richest city in America. And an ecosystem around whaling was built, effectively kind of a collaboration between investors, advisors, high net worth individuals who funded these expeditions. They analyzed data to chart different routes to go in search of whales, and effectively, constructed these large boats that had small boats on them. They went off into the unknown. If they were lucky enough, the captain would receive 7 to 12%. The first mate would receive a lower percentage. But if they were lucky enough to find a whale, harpoon it, get dragged through the icebergs and return, the rewards were pretty enormous. And looking at the data from 1858, the cost of doing this in dollars at the time was around $20,000 to $30,000 for an expedition. The returns, if you managed to find a whale, were around $150,000, so life-changing in those terms. I'd argue, obviously venture capital investing today is significantly less risky than it was back in those days, and only a third of ships actually returned with whales. A third didn't return at all. So I think we're in the fortunate position where we don't have to worry about that risk versus reward. The empirical data today is very clear. If you look at the return of the S&P over the last decade, it's returned between 9 and 10%, a top quartile for venture, is somewhere between 1.5 and 3 times that as a return, somewhere between 15 and 27% over the last decade. This is meaningful. It's had a profound impact on most of our lives. The iPhone in your pocket, any orders from Amazon, mRNA vaccines, electric vehicles, we're all venture-funded companies. In fact, 95% of the market capitalization that's been created, 75% of the market capitalization that's been created since 1995 is actually venture-funded companies.
So, I think what's exciting about venture capital investing is that if you compare the returns of S&P 500, say, over the last decade, we've had a return of around 10%. Venture has delivered anything between 15 to almost 30% per annum from the very good companies. Now, Jacob, over to you. Bravos funds invest in everything from deep tech, healthcare, AI companies, quantum, climate change. But personally, what areas of venture investing right now you are most excited about?
Well, first I want to thank the organizers for putting together that amazing video that gave us so much context for the discussion this morning. The frontier, by definition, is what you're not going to see on that video. I think it's helpful you see the computer as a thread running through that story, and venture investing over the last 3 decades has really focused, with the exception of biotech, on internet software companies. Those have delivered tremendous returns, those have transformed our lives. But I think, for me, what's really exciting is, another part of that video that was interesting was Elon Musk talking about capturing the imagination of a new generation for space. We're seeing we've seen a lot of progress in software, but less progress in the world, in the physical world, in the world of atoms, as opposed to bits. So I think I'm most excited about progress in these hard tech areas where we invest.
Another question for you. I think those of you that monitor sector-specific returns, biotech in particular has gone through quite a tough period, 2022-23. The high interest rates that we have seen certainly have not helped matters. And yet, despite that, Blackstone has raised, since November, $1.3 billion into a Blackstone private equity strategies fund. So investors are clearly getting excited about venture right now. So what makes 2024 different to what we have seen?
Yeah, great question. I mean, 2022 and 2023 were tough years for venture after some of the excesses of 2020 and 2021. In our own portfolio, we saw not a lot of activity, a lot of helping our portfolios, companies wanting to tide over until the market recovered. And a lot of that was to do with some of the excessive valuations that we saw in 2020 and 2021 in the zero interest rate era. And coming into 2024, those valuations have reset, and the opportunity set for investors is extremely exciting.
Arjun, over to you. Let's talk about clean energy. I think it's a topic, very relevant to South Africa. I've seen an article in Business Life today with a promise of load shedding ending by 2024. I nearly laughed. Never mind what ANC will say just pre-elections. But I think it's undisputable that in terms of expert knowledge, that we are going to cross that magic 2 degrees Celsius threshold that is irreversible for humanity by 2030, with massive implications. One of them being that, again, estimates are that by that stage we will see around 1.2 billion climate refugees moving north from Africa, which will be most affected by climate change. And I was laughing. I was at a conference again in Miami a couple of weeks ago, where US thought that they have illegal immigration problems. They don't know what's coming. So, talks about renewables as the solution. But is that enough, looking forward? Or do we need innovation?
Well, like you say, we're going to cross the 2 degrees. I mean, the Paris Agreement said 1.5. I mean, I think no one today believes that we are going to stick below 1.5. We are going to reach 2, and we're going to go above it. And the implications of that are pretty profound, as you've described, both in terms of loss of life, loss of livelihood. And I think that the way to think about climate change is there are three strategies that the world can employ. There's reducing the amount of carbon we put into the air, there's taking that carbon out of the air, and lastly, there's also measuring how we're doing, which is critical. As Andre often likes to say, if you can't measure it, you can't value it. And everyone in this room clearly thinks a lot about valuations, so that's a very important point. And renewables themselves are great. I mean, I've been traveling around South Africa for the past couple of weeks. I've seen a lot of solar. I think what's clear is that we are potentially, in the next few years, with innovation, able to meet our demand. We've got a company in the Oxford ecosystem, on one of our portfolio companies, First Light Fusion, that's harnessing the power of the sun, creating fusion energy, and doing it via quite an interesting way, using a rather large gun which shoots a bullet at 65 kilometers per second to compress fusion fuel. And but producing that energy is not enough. You also need to store that energy, which is where the bottleneck remains in many countries, including South Africa, especially if you're in a remote location, if you're a farmer. And at the end of the day, like we've seen, like those are the people who are going to be most affected by climate change. And then, so then you have to actually remove the carbon from the atmosphere. There are several companies doing that. We've got a portfolio company called OxyCU, which is taking the carbon from the air, combining it with hydrogen, green hydrogen, and then producing jet fuel. So you're effectively creating a carbon neutral loop, and then you can take that jet fuel and fly your planes, and hopefully the politicians flying to the next COP summit will be flying with neutral jet fuel rather than adding to the problem.
I mean, you mentioned First Light Fusion, and I've seen it, and really, what is interesting about it is, fusion has been around, as we know, for many years, but for the first time we are seeing true breakthroughs in generation of energy via fusion. And, as you mentioned, First Light Fusion, really, it's a ginormous gun, which, from my perspective, it was like firing Nescafe capsules at a black magic box hanging far away, and by smashing the two together, generating fusion. But other things, what are the most exciting innovations, apart from First Light Fusion, that you are seeing in that climate change space?
Yeah, sure. There's many others. Like I mentioned, this company, OxyCU, which creates these jet fuels, is another very exciting company. There are many companies doing measurement, which is also very important. Now, over the next couple of years, we're going to establish a very robust carbon credit market, and I'm sure there's enough people in the crowd here who are already thinking about how they are going to invest in that space. But what's most exciting to me is a company of ours called Wild Biosciences. Now, Wild Biosciences has multiple different products. What they effectively do is to engineer crops to do, different things that previously thought to largely be impossible. Their three key products are especially well suited for combating climate change. As climate change accelerates, we're going to have less land to grow food on. So what Wild Bioscience does is increase the amount of yield of seed or whatever other product produced by that crop. And they do it by a whole bunch of clever genetics, but that's for another day. The second one is they have drought-resistant crops. So in fact, what they currently are trialing are drought-resistant maize, which are growing in a desert in Argentina, which is quite a sight to see. And that's incredibly useful for climate change as the world heats up for obvious reasons. And then lastly, which is one of the most intriguing, is they pull out carbon from the atmosphere and sequester it in the soil via the plant's roots. Now, this is not like planting trees. Planting trees doesn't actually work to sequester carbon in the long term, because eventually the tree dies, you burn it, you eat its products, and then you breathe out carbon dioxide. So, trees are not the solution for long-term carbon sequestration, but trapping it under the earth certainly is, and this is what that technology is unlocking, and it's very excited about that.
I think, when one thinks about climate change, clean energy, one very seldom, makes that leap of thinking about the implications to food security that, that implies. But let's jump over to AI for a second. There is a lot of hype about AI. I think all of us are aware of that. But there are limitations and risks to the AI as it exists in its current version. Alex, so maybe you can touch on that and tell us a bit about that.
Absolutely. So I think when a general public talks about AI, what they really tend to be talking about is one of two technologies: large language models and generative AI, because that's what all the news in the past couple of years has been about. Large language models, I think the fundamental limitation is the nature of the technology itself. How ChatGPT and all these other companies work under the covers is on word prediction, constructing the most likely sentence in response to a prompt provided based on figuring out the most likely next word for a sentence, which evidently has unlocked these incredibly powerful capabilities. But that's not to say that that methodology leads to good judgment, where at the end of the day, what they're modeling through most highest likelihood is the exact data that it's already seen. That means these large language models are not well prompted to answer a question by saying, I don't know, because that's not what the nature of the data that has been scraped and used to train them. That's where the ability to pull the brakes, like a human being would, say, I don't know this, I can find this out, I know how to find this out, I can show judgment across multiple different sources of information, is lacking. And that means, at least for now, large language models remain a tool for human beings to use, but not a replacement for human beings. As for generative AI, I think the fundamental issues there, on top of high computation costs of generating anything, are actually legal in nature. The way in which images and videos now are being generated have some serious implications in a very tight legal environment over IP law, but also the most obvious applications for these technologies in Hollywood movie making also happens to be a space in which some of the strongest protections for workers against AI as a result of the Writers and Actors Guild strikes of last year exist. So there is this huge barrier to commercialization that has to be solved before really you're going to see a really exciting change in that space.
So you kind of, mentioned effectively entertainment industry, and again, I was this Miami conference, and I got to meet one of my, 15-year-old idols. For those of you that remember Rob Lowe, so his poster over my bed. Very good-looking guy, but he was talking about AI in entertainment industry, and he was talking about how that has reduced cost of production. They no longer have to build elaborate sets. They can act in green rooms, and very realistic projections of sets are appearing behind them. They can use special effects, so they no longer have to use, makeup and spend 6 hours in makeup. It's all done afterwards through special effects. They can use lip syncing to translate actors speaking multiple languages. But from your perspective, what is the most novel application of AI that you have seen right now?
Right. So I think this one's a really exciting one and hasn't got that much traction in a non-technical environment. But it's this insight that large language models might be unlocking general purpose robotics. Household, that sci-fi dream of a robot butler. A lot of people, when they think about robotics outside of factory or warehouse settings, they think that the main obstacle is hardware. But if you've been watching and paying attention to the research coming out of companies like Figure or Tesla or Boston Dynamics, you're seeing robotic bodies that can achieve and perform small tasks with amazing dexterity, amazing balance. So the issue here has actually become a software issue. How do you take the kind of task someone would like in the household, clean up a room, crack and fry an egg, fold laundry. These tasks feel intuitive to us, but they're actually a sequence of microtasks. Those microtasks a robot might be able to do, but how to plan them out is a very difficult, meaty task. And that's where large language models, recent research is coming into effect. They're good at reasoning. You can try it out yourself. Ask ChatGPT to break down frying an egg into a series of steps. Feed those steps into a robotic body that knows how to do one of those small motions, chain them together, and suddenly that huge roadblock in terms of achieving the sci-fi fantasy suddenly seems to disappear. So I expect to see really exciting things happening in that space in the next few years.
Arjun, your specialty is healthcare, and healthcare is also a very topical issue in South Africa right now. We need more. We need more innovation. But from your perspective, what are the main problems with the healthcare delivery model as we know it?
Well, at its very core, developing a drug is very expensive. The cost of the average drug development timeline has risen to about 2.5 billion, including all of the clinical trials and tests, and also all the cost of the failed drugs that don't actually reach it. For a complex drug, a next-gen drug like a gene therapy or cell therapy, that cost is closer to 5 billion. And from the perspective of pharma, they really are, like all of us, they're asset managers. It sounds like a bit of an ad. You too could be a pharma exec. But as a result, they need to recoup on their investments. So they charge what they need to, especially when there's very few patients for a rare disease. That charge gets really high. Hemgenix, which is a gene therapy for hemophilia B, costs $4.5 million a dose. And that, there's only a few people in the world that can pay that. There's only a few populations, few types of insurers, and that's all in the concept of the global West. It's the US, it's Western Europe, and very few other places. So as a result, those drugs just never get marketed to places like South Africa or developing countries. And after they come off patent, which is how the pharma companies are able to charge what they charge, after they come off patent, these drugs are just never produced because the cost of manufacturing and the difficulty manufacturing with small populations doesn't justify delivery to any developing countries. So at the end of the day, people just don't get these drugs, and that's one of the fundamental problems. So we need to speed up and cheapen that drug discovery process. We've got a portfolio company called Charm Therapeutics, which is using AI to create a 3D model of how a drug binds to its target in the body with very high fidelity to what actually happens. It's inspired by DeepMind's projects, and innovations like that are the breakthroughs which result in both better medicines but also more accessible medicines.
Currently, and that's quite a scary statistic, over 40% of world's population does not have access to diagnostics and the ability to diagnose diseases and hence treat medical conditions. Is innovation an answer? Have you seen anything in this, specific innovation space that could make a material difference?
Well, so, one of the portfolio companies I'm most excited about is a company called Osler Diagnostics. It's effectively a little box where you put in a sample of blood and it can diagnose any blood-based measurement that you want to take, effectively enabling you to diagnose various types of diseases, least of which is diabetes, which is obviously a thing. But then you can also start diagnosing heart attacks. You can start diagnosing all types of blood infections, and really the possibility is endless. And like you say, we also need to understand why not having effective diagnostics is that much of a problem, as opposed to also not having that much access to treatment. With lack of diagnostics for people never reach the point where they're getting treated. So, imagine you're working somewhere even slightly remote, maybe about 45 minutes, an hour's drive from the nearest clinic, and you're 45 years old, and then you get suddenly you get chest pain, and you do know that like you probably should get checked out, but then you're like, it's probably just heartburn, and you go about your day, and just you pass away that night from a heart attack. I can tell you that's how my grandmother passed away, and she wasn't even that remote. But it's the convenience of the diagnostic is incredibly important to actually creating the possibility of intervention in a time window that enables effective cure. And something that we discussed as a team quite a lot is this transition from moving from sick care to health care. And you can only do that by monitoring the body, monitoring its steady state, its daily functions, to start picking up on things where you don't just make interventions when you're seriously ill or you're on death's door. You start making interventions long before. I mean, Alzheimer's, it's, people get Alzheimer's at 80. No, they don't. They get Alzheimer's at 40, but it only shows up at 80. So, that's why Alzheimer's is so difficult to treat. The damage has been done, but that's what diagnostics unlocks. It unlocks the ability for you to know yourself and make interventions as you actually need to.
From the healthcare perspective, I mean, some of the drugs we've seen currently gaining humongous traction are obviously the weight loss drugs produced by companies such as Novo Nordisk. So huge innovation in that space. Alex, everyone here is here because they want to know what they should be investing in, apart from the weight loss drug companies. But if you look at AI, and we have already seen returns from the big 7 techs in the last year exceeding 100% returns. We know that NVIDIA, which manufactures chips, has reached this lofty $2.2 trillion valuation. But what else? What should we be investing in terms of accessing AI?
Sure thing. So outside of the hardware space with NVIDIA and other chip manufacturers, I think the reality with the kind of AI exposure people are looking for is that these technologies take a lot of resources materially to train up. The entire premise of this revolution of AI we're experiencing is off the back of massive amounts of data and massive amounts of computing power. That costs money, and that is why big tech isn't late to the game. Big tech is already the game. They own huge stakes. In as much as we hear the names of startup companies, OpenAI, Anthropic, Mistral, they are bankrolled and their profits are owned by big tech. Microsoft, being the big player that everyone knows, obviously has this huge investment in OpenAI. What's possibly a little lesser known is the fact that they own 49% of all profit OpenAI ever make. On top of that, they have recently made this huge $1 billion investment in Mistral, the kind of leading LLM company in Europe. So regardless of how the EU's AI Act goes, Microsoft has exposure to players both within and outside of Europe. They have this exposure that few other companies do. But Amazon, huge $4 billion investment in Anthropic, OpenAI's potentially largest competitor, founded, by the way, by ex-OpenAI researchers. Google and Meta have huge investment wings, so they're getting a lot of that startup exposure, as well as the fact that their internal research is some of the leading in the industry. As much as Google's received a lot of bad press in the past few weeks, we should not forget that this entire revolution was premised off of research that came out of a Google lab that they made public access, the transformer architecture. So writing them out of the game is a mistake to begin with. And as much as it's been considered completely late to the game and absent from conversation so far, Apple is posed to make some really big moves in the generative AI space this year. They closed up shop on their electric vehicle project a few weeks ago, freeing up a lot of R&D spend, and they have promised that in typical Apple fashion, they're only ready to announce literally days before they go out to the market. But right now, the focus of their research, billions of dollars now, is going into generative AI. So whether their offering will be strong or not remains to be seen, but they're there too. So yeah, I think at this point, big tech has already captured the market, and that's probably the safest bet.
So we're really talking about continuing with FANG investing. Andrea, I'll give you 1 minute to tell me what company right now you personally, never mind the funds, you personally would invest in. This is not a recommendation, by the way.
The company I'm most excited about is actually a company Arjun has already mentioned, point-of-care diagnostics, going to change healthcare, cheaper, faster results. It's going to have a huge impact, disrupt the healthcare industry, which is 20% of GDP in the US, and I think the company has the potential to be particularly large and form very favorable partnerships in the next 12 months. So very excited about the outlook for Oslo.
So that kind of talks to Jacob, over to you. It talks to how returns are generated in the VC space. Oslo, as you mentioned, is a private company. So, as much as you will potentially generate outsized returns from Oslo, there is this inability to access Oslo unless you invest in a VC fund. So let's go to VC funds, because people often misunderstand the shape of returns from venture capital funds, how returns are earned. Everyone here is very used to short-term gains. I mean, volatile, but short-term gains from equity markets. That's not what VC is all about. It takes longer. So maybe you can touch on how the returns are actually earned. What's the shape of the returns?
Yeah, it's a great question for people who mostly invested in the listed markets. This is very, very different, both in terms of the returns, but also how you get the returns. So I'll take that in sort of chronological order. In order to get the returns, you have to be invested in companies that generate outsized outcomes. Venture capital is a power law industry in which a small number of companies drive the performance of the asset class. And those opportunities are not available. They're not written down anywhere. They're not listed on the exchange. And in order to access them, you have to first be able to find them early, know what they are, know where they are, know who the people are, and develop relationships with them so that you can have access to those early stage investments. So there's a kind of very personal and local knowledge aspect to it that I think is underexplored. And then in terms of once you are running a portfolio of these investments, there's no mark to market. So the valuation of a company will remain the same, same price as you paid, or whatever the last person invested at, for a period of 18 to 24 months until the next financing round. So portfolios, for instance, our portfolio over the 2022-2023 period, as I alluded to, that was a very slow period for financings, and a lot of companies were delaying financings until the market recovered. So really, the companies in the portfolio and the portfolio as a whole can, for periods of time, can go like this. And then when you get this next round event, which is predicated on the company hitting technical, commercial milestones, you'll get a valuation uptick. And so the return profile looks kind of like a staircase. You'll get these kind of lumpy upticks as companies revalue. And as you get into a mature portfolio, you get into real convexity, and those upticks become larger and larger as you get into the power law of returns.
So really what I would be waiting for is these big bursts of returns in terms of, I always think about it as a bit of a staircase. Mm-hmm. Flat valuations, revaluations that happen, but hopefully also some form of M&A activity or a listing activity where hopefully you're getting a big boost to your returns.
Just one thing I wanted to add to Alex's answer about AI. I think it's also worth looking at the second derivative, which Alex talked about these models being very expensive. They're expensive in money, but they're expensive in energy. And I think one of the things, observations, that's been really interesting over the last few months is how the big compute providers, the data center runners who are training these models, are co-locating often new sources of energy, new kinds of energy production with these data centers. So Amazon just co-located a data center with a nuclear power plant. And I think the next generation of things like nuclear energy are going to be an important part of the second derivative of AI's massive energy consumption?
Andre, we're kind of running out of time, but I wanted you to, in summary, and summarize what we've heard. With all of your experience in venture capital investing, I think you hold over 80 VC companies and spin-out companies in your personal portfolio, and you've been involved with Oxford and Oxford ecosystem since 2015. So what made you focus on Oxford and effectively co-found Bravos, which centers around Oxford ecosystem?
Yeah, very simply, Magda, I was in investment banking, as you know, for a long period of time, and I saw the model being disrupted, and I had a very strong view that now was probably the most interesting period of time to be alive. The couple of decades either side of where we are now will probably turn out to be the most interesting, both in terms of the ability to create wealth and businesses being disrupted. I'd lived and worked in the US, and I'd seen that the right amount of ambition, the right amount of capital, and the extent to which risk could be favorably rewarded in terms of bringing the right partnerships and the right groups of people together could create outsized returns, and was fortunate to participate in some of that. Oxford, as you know, is the #1 high-rated education institution in the world, 800-year-old university. It's #1 in maths, physics, life sciences. I kind of had this view, having lived and worked in the UK relative to the US, that the academia and intellectual horsepower was probably on a par with the US, yet valuations were significantly lower. I thought that the transition and acceleration in AI and compute would lead to outsized gains. As human beings, we're linear thinkers, not exponential, and the exponentials are only accelerating, be it AI, quantum. And I think if you look at the amount of money that's gone into academic institutions and the amount of IP that exists within there, they're actually significantly less risky investments than one assumes at the outset, given the traditional venture funding model. So in a nutshell, this is probably the most exciting opportunity I've come across in my career. Again, back to that stat I mentioned earlier, 7 of the 10 largest companies in the world are venture-backed companies. It's not hard to think that back in the early 2000s, Mark Zuckerberg turned down a $990 million bid for Facebook because he wanted $1 billion. And, we're many hundreds of multiples higher than that. So time is your friend with this model. The ability to disrupt existing legacy incumbent industries has never been higher, and I think opportunity to solve some of the most pressing problems has never been more available. So, the opportunity that's going to come out of that, I think, is probably the best opportunity you're going to get. And I certainly wanted to position myself and within the Oxford ecosystem to be able to capitalize on that.
I probably have 1.5 minutes before Kevin chases me off. I don't think there are any particular questions, and we are running out of time. In terms of VC investing, I just wanted to point out that there are funds that South African investors can access. You do have to have special licensing, FSCAs, Cat 1, Cat 2 licensing in South Africa, but venture capital investing is not out of the realm of accessibility for South African investors. And, I never want to plug Signia. A lot of you do associate us with Signia, but, we have identified the fact that those outsized returns, that asset class does belong in diversified, well-diversified investment strategies, not hugely, but, you don't want to miss out on maybe 1 to 2% allocation. And of course, there is FANG. So if you do want to know more about accessibility of venture capital investing, I know that Signia staff is around and they can answer some of your questions. I think all that remains is for me to say thank you to all of us for being here, and thank you to a panel that has come from afar to talk to you. And I hope that you found that topic interesting. Thank you very much.